All right, so what's up, everybody, and welcome to another episode of the Abundance Podcast. So, here with us today, we have Gary Curtis, a very interesting guest. So, Gary is a global macro analyst and foreign exchange expert, and he is the vice president of LP Operating, an investment fund that drills and extracts oil. So, what's up, Gary? How are you, man?
Good, Alexis. I'm real good. How about yourself?
Pretty good. Thanks for coming on the show. So, why don't you start by telling us a little bit about your journey and your current projects?
All right. So I guess it depends how far back we want to go.
So
Uh,
let's begin. Tell us who you were in high school, like what man were you in high school, and how you went from that man to being the man that you
all
are
right.
today.
Well, high school was sports and just trying to figure out what to do. After that, did the collegiate route, and then I figured out that I wanted to do accounting. So I studied accounting and economics, my undergraduate studies. When that happened, or when I got my degree in accounting and economics, I then went into the workforce, like everybody does, of course, and learned quickly that accounting was important to know and understand and work. But I was sitting in front of a computer all day, and I just kind of got burnt out over it. Mix that with the fact that, well, I kind of got burnt out, but I really enjoyed the information that I was getting out of it. Um, and then the global financial crisis hit in 2008, 2009, and they had a pretty big downsizing in the company that I was at, mid-sized company, commodities type company. And then I was let go. So then back out into the workforce. At that point, I decided to go back and start a master's degree in economics. Quickly realized it was not really something that I wanted to do at that point in my life. And I had met this individual out in San Francisco that worked for a very large brokerage company and was a strategist, a currency strategist. And so I basically packed my bags up, drove to San Francisco, and then I got an internship as a research intern on the research desk. And then at that point, that's where I learned. It's what I really wanted to do long term was understand these concepts that would drive the macroeconomies. And then I really learned, what are the influences, what are the factors that drive exchange rates. And at that point, I was covering the Asian market hours, which is covering Japan, Australia, New Zealand, China, and the United States. And
Mhm.
I'd write, I'd publish, and I would assist the full-time research guys, whatever project they needed to have done. I'd provide them data, updates, alerts, and just prepare them for what they're going to do for the rest of the day. And that was a great job. That was, out of all the jobs I ever had, even though it didn't really pay anything as an internship, and the hours were from 4 in the afternoon until midnight, sometimes 1, 2 in the morning. I got more out of that in terms of knowledge and value than I did in terms of money. But I'd say that was probably my favorite job I've ever had. And I worked hard, worked 2 jobs during that period of time. I also worked in accounting for an engineering firm in San Francisco. And then when that was over, I go straight to my job as an intern. And then did really well in that, really enjoyed it. And the research guys said, hey, clearly you're doing a good job. You knew going into this there wasn't going to be a full-time role for you in research, so we have positions available on our desk, our brokerage desk, working with clients. Would you be interested? And I said, absolutely, I'd be interested. So then I started working with our clients, and it was traders, guys trading the foreign exchange market, big retail brokerage, the biggest in North America, actually, in the United States. It was the biggest foreign exchange trading brokerage in the United States, and had a massive global footprint. And I really enjoyed talking about the markets and trading and helping out these traders to gain more success in what they were trying to do, which was trade the markets. So I really enjoyed that. January 15th, 2015 came around, and I don't know if you remember this. We spoke about this prior, but that's when the Swiss National Bank pulled their peg from the euro at 120. And when that happened, it caught a lot of people off guard, including us as a brokerage and our clients specifically, because most of our clients were long euro Swiss because they put a floor at 120. So, it would go above 120, go to like 121, and then back down to 120, and they would just they would trade this on a continual basis. But our book had a very large buildup of clients on this particular Euro Swiss trade, and
Mm-hmm.
Swiss franc in general. And seemingly overnight, not seemingly, but overnight, the Swiss National Bank, uh, their governor, basically said, "Listen, we're no longer going to support 120." And then at that point, the currency market more or less fell apart. The banks couldn't even quote Euro Swiss and some of the Swiss pairs during a very short period of time. So even though clients had stops and whatnot in place to protect their losses, the fills were 30% away from their stop, for example. And so that ended up leaving us as a brokerage with about $200 million in losses that we had to collect from either our clients or we had to make our banks whole. And so that was a big moment in my career in finance. And so we went out and we collected some of the money. Ultimately, at the end of the day, it didn't seem overly encouraging to want to continue my career path there, even though it's a place that I really loved to work at. I liked everyone there. It was great. But at that point, I knew it was time to make a shift. And so it was at that point, I had some buddies that were working in the global payment space, kind of like a brokerage, but helping mostly small businesses and some mid-sized businesses send and receive payments in foreign currencies. For example, if you're a U.S.-based firm and you need to buy $1 million piece of equipment in Germany, you'll put in the purchase order for it. You'll receive delivery of the machine, and then at some point, you have to make that future payment and take your dollars, convert them to euros, and settle that transaction. And so in that interim, whatever that period of time is, 30 days, 60 days, 90 days, you're going to have exchange rate risk. If the dollar loses 10% versus the euro, your piece of machinery now just costs 10% more. And a lot of companies, their margins don't allow for 10% fluctuations, especially if their cost of goods sold is really high, for example. And so I spent years working with small businesses, helping them out with either whether it's getting better exchange rates, making payments more seamlessly, or hedging out their exchange rate risk. And that was great. Did that for several years and then built up a book of business. And then COVID hit. And when COVID hit, global commerce more or less kind of fell off a cliff.
Yeah.
And so that was also at the same time, though, that oil futures went negative. And so someone that's always looking at the markets every day and seeing where the opportunities are at, my book of business in the global payment space basically fell off a cliff, but I saw oil futures went negative. So I'm in this really neat community right now. It's important to network, right? So I was in this really neat community and I met these guys that operate oil and gas wells out in Texas. And so I started talking with them, and then I very quickly learned that because when oil prices, especially when they go negative in the futures market, oil and gas is going through a very significant recession for the very same reasons the currency business fell off the cliff.
Mm-hmm.
I learned that you can drill wells when oil prices fall. Drilling costs also fall commensurately with prices. They tend to lag a little bit, but they fall. So if oil prices are trading at $20 spot per barrel, you can drill and put wells together for very, very low cost. So you can set your break evens for really low. And then if the market recovers, as I was speculating that it would recover, find yourself in a position where you have a really wide spread on your product.
Mm-hmm.
So that's what's led me into the oil and gas business.
Right. So, pretty interesting journey that led you into the oil and gas kind of uncredited journey to where you're at today. But so tell me about let's talk about a little bit about the foreign exchange market and the driving forces of the macroeconomic, because I know a lot of traders in the foreign exchange market. I myself trade sometime in the foreign exchange market, but I don't know anybody who's looking at the fundamentals of the foreign exchange market to do trades. So let's dive into this. So if you had to sum it up to the two main forces that drives the supply and demand of a currency versus another one, how would you sum it up in two or three main forces?
Yeah, I would say the primary force that drives exchange rates let's say euro dollar, for example, or any of them for that matter, is mostly the biggest driver is interest rate differentials,
Yeah.
or and even more than that, expectations for changes in interest rate differentials.
Mm-hmm.
That's probably the most important, and that's what drives a lot of markets. You can say that has a significant driver on um, interest rate products, significant driver on stock market, specifically a very significant driver on exchange rates.
Mm-hmm. Yeah.
For for example, if you want an example, like right now, um, there was, as you know, CPI, consumer prices inflation. That's one of the Federal Reserve's dual mandates. They want to help maintain stable prices. Their targets has historically been in about 2% inflation. As you know, when COVID hit, there was a lot of new supply of money hitting the markets, and that's led to, down the road, high inflation rates, well above their target at the very least. So, to help fight inflation, one of the things they can do is increase the cost of capital. So, when you increase the cost of capital, there's less of an incentive for people to borrow and spend. Debt servicing costs go up, and it tends to put the brakes on the economy. So market participants, the guys that trade the currency markets, they try to get ahead of these things and try to anticipate what's going to come next. And so,
And they're not the only one trying to anticipate what the Fed is going to do.
right,
Everybody's speculating on this.
everybody is. Well, the currency markets do that too, big time.
Yeah.
And so, leading to where we're at now, I mean, that was just, kind of what led to the interest rates going higher. They were high. They've been high, of course, rapid acceleration rates across the yield curve. But also, too, we recently had some stress in the banking sector. We saw like Signature Bank, Silicon Valley Bank, First Republic. They placed some bets on interest rate products. They bought some debt, basically, that was at low rates. And when interest rates go up, the value of their debt products go down because they're inversely related. And so they needed to sell some of that off. And there was a panic, and some of the customers' money was basically leaving the bank at a quick rate. Capital flight. And so you had a couple banks go under. And so that dramatically shifted rate expectations to higher rates down to lower rates. And so the markets for like federal funds futures, for example, they're looking at, all right, when that hit, rate expectations now were to call for rate cuts in November of this year. And so people speculate on these things, and it gets priced into the currency market. So the dollar is going to move relative to these expectations. But recently we've had some dollar strength across the board, and we've seen that. And so sometimes the market will move prior to really understanding what happens, what's happening, because if the market's pricing in lower rates because it's going to put the brakes on the economy. And when they do that, Fed's going to have to cut rates to re-stimulate economic growth. So the theory goes, or so the cycles tend to go. You'd think that'd be weak for the dollar. And it was. The dollar pulled back, had a nice pullback.
Yeah.
But recently, as of the past, call it like month, the dollar's been strengthening. And seemingly there hasn't been a lot of material changes, except for now what people are talking about is rate hike expectations are starting to build. So now, instead of going from cuts in November, cuts are being priced out at some point, call it April, May of next year. And now we're talking about another rate hike in June next month.
And, I think it's nice to put our situation into perspective, right? Because for the past several years and even the last decade and more, the rates has been historically insanely low, right? I'm not even talking about COVID. I'm talking about even before when it was at 5, 3, 2%. But when you look back in time and far back in time, you see the rates all the way up to 10, 15, 20% in the most extreme cases. So really, right now, if we're not able to handle 5% and inflation, depending on various factors, but inflation is kind of not slowing down that much, in my opinion. So 5% is not that much, so we better be able to handle 5% because historically it can go way higher than that.
Yeah, and it's all relative to how much debt there is in the system too. Like, there's a lot of debt in the system right now, so 5% on a lot of debt could be a very heavy burden. And we're starting to see some of those cracks in the banks right now. So who's to say? I don't know. I mean, back in the 80s with the high rates up to 20% in the 80s, a lot of that had to do with going off the gold standard, taking the
Yeah.
dollar off the gold standard. And it created a lot of inflation. And Paul Volcker wrote a really good book about that when he was the Fed chair at that time, what he had to do, the sacrifice that he had to make to break the back of inflation, more or less. He did it at a cost, but he did it. So we're kind of in that period now. It seems like the Fed is going to have to aggressively keep rates at a higher level relatively to the debt, but the debt burden is high now, even at 5% on so much debt. But
And here you're
it
talking
seems,
not only about the debt of the US, but you're talking about personal debt, right? Credit card debt and consumer debt.
yeah, well, that's the brake. I mean, those are the brakes that it puts on the economy because if you have adjustable debt, for example, it's going to adjust from a low rate to a higher rate now. And that's part of your disposable income that you're now using to service debt. You can't go out and spend it in the broader economy. So it slows down the economy. We're starting to see it actually in the rate of change in corporate profits, for example, on a quarterly basis. It's still, companies are still profitable, just not as accelerated as they were prior.
Especially
And
small companies. Small
yeah,
companies with 5% interest rate and going up. I mean, it's hard for them, and that's what
right.
happened in Silicon Valley Bank, right? It's not so much that they couldn't handle the rate hike. It's that their clients were small companies that needed the cash right now because of the economic climate. So for small companies, a rate hike like this and this a recession, it's hard.
It's tough. And, the labor force, to adjust for inflation, they need to demand higher wages.
Yeah.
So you can do that as long as a company can pay higher wages as long as they're making money. But as soon as that squeeze sets in and they're not earning what they were earning, they can't get the prices they were getting for their goods and services, but they're still paying high labor costs and high input costs, puts a squeeze on profits.
Hmm.
Um, Down the road, if the trend continues and there's still a significant squeeze on companies, eventually, if they start losing money over long enough periods of time, when they start to realize that we're not in an environment where we can make a lot of money, they'll have to start cutting areas. And one of those areas that's cut in every cycle is the labor force. It's the last to go because human capital is expensive to get. It's hard to find. You have to train them. You have to get them ready. You have to spend a lot of money for them. So they're usually the last to go. But eventually, if this cycle does play out, we'll start to see the unemployment rate tick higher.
Hmm.
And that's kind of your significant lagging indicator to say, hey, listen, we are in a recession. I mean, right now it's not totally clear if we are or aren't, but what is clear is that the high rates will put the brakes on the
Hmm.
economic system. All that's to say is to relate it back to exchange rates, where currency rates, where's Fed policy going today relative to, say, um, policy in Japan, for example, or the Eurozone, or any of the countries. So you start breaking these things down, and then if it's expected that that interest rates are expected to increase in the United States and stay the same or not increase in, like, Japan, for example, then it's likely you'll see a rise in the dollar versus the yen. And we've been seeing that. And so
Hmm.
that's
So talking about the dollar a little bit, that's a subject that I aboard in a lot of my podcast that I talk about in a lot of my podcasts. So, what do you think about the current situation of the threat of the U.S. losing the world reserve currency?
I don't know. I mean, there's a lot of talk about it,
Yeah.
as you know. When the Fed more or less weaponized it with the sanctions. A lot of Russia, for example, a lot of other countries, kind of woke up to the fact, like, hey, this can be used as a tool.
Because of the
But at
SWIFT.
the end of the day, the dollar is woven into the fabric of global commerce. So to say that that's going to go away anytime soon seems like a long shot, quite frankly. Um, I just do a lot of studying, do a lot of reading, read from some of the best people that are out there. And there's some guys that lay out some amazing cases to where it doesn't seem likely anytime soon the dollar is going to lose that status as the global reserve currency. But historically speaking, if you go back and look at some of the research and some really good materials that have been written by people that are incredibly brilliant,
Like Ray
um,
Dalio.
yeah, for example, right, amazing work. Um, Historically speaking, you lose a big war, um, you can lose your reserve status. It does happen,
Hmm.
but it just I don't know when that actually happens, but certainly it could happen. I mean, it does historically. It does. All empires, or if you have a global reserve currency, you can lose it.
Yeah.
But I mean, right now, it's just I don't
Hmm.
see that happening because, like
And
for example, China, for example, if you look at their currency, they have an onshore and they have an offshore currency, and they're trying to develop their financial system. But to the best of my understanding, it's still relatively closed off to some degree, and they're trying to develop it right now. But to the best of my understanding, they have capital controls and some things like that, so it's not as freely traded as it needs to be, and there's not enough liquidity that there needs to be to actually service global commerce.
hmm
So, but
yeah,
it's
and that's a point I make often as well. Is I don't know when it's gonna happen, but it definitely is gonna happen. That at least is my strong opinion. Like it might happen in a decade, 2, 3, 5, 6 decade or more, but it will definitely happen because it has happened for all of the empire in all of human history.
perhaps, or maybe the United States is an
Breaks the
anomaly.
pattern.
Who knows? Who
So what will
knows?
happen to the debt then? It will just keep increasing to infinity.
Well, well, I mean, I guess if you can print your own money and buy debt with it, I mean, probably there will be some kind of. I was having this conversation earlier. There will be some kind of restructuring done with the debt. Uh, Taxes will most likely have to go up. Maybe some government programs will be let go of. Something's got to happen. But for now, we're going to continue to run with deficits. The debt limit will increasingly will get pushed higher and higher and bumped higher and higher. There's going to be a lot of heated debate about it. It seems very likely. I don't know what the solution is. Luckily, that's not my job. But it's fun to talk about it. It's fun to think about it because these things have big impacts on our lives, whether we want to recognize it or not. And we have to navigate these things well.
Hmm. Yeah, I think they're just gonna print more money to pay the debt and create inflation.
That's very likely. I mean, that's what's kind of been the trend. So we'll see. Unless we move into a period of significant deflation, if we have another debt bust, there could be high deflationary periods too.
Hmm.
Last one we saw was in 0809.
Yeah.
Uh, that led to very significant deflation. And
Hmm.
part of the reason why we did so much stimulus for years and years and years coming out of that is we weren't fighting inflation, we were fighting deflation. That's the central bank was, and that's why rates were more or less kept at the bottom floor, and they were doing lots of quantitative easing, buying toxic debt, doing all these things to reinflate an economy to where it was significantly deflationary.
Yeah. I would argue that there's more risk of hyperinflation right now than deflation.
Well, perhaps you can certainly make that argument. um, what do you think would have to happen to see that?
I mean, for hyperinflation.
Yeah, like the hyperinflation that was in Brazil in the 80s,
Hmm.
Argentina, like that
I
kind
mean,
of
what will happen is if the mostly Saudi Arabia and other countries, if they would start to consider to trade oil in other currencies, right? If the petrodollar agreement continues to weaken and people start exchanging good in other currencies, especially oil. Really focusing on one good, which is oil, because it's the turning point. So let's say Saudi Arabia in the next years says something like, "All right, well, we're not satisfied with the military help that the U.S. has been giving us in Saudi Arabia around against Iraq and other countries.
Mhm.
They're not protecting our oil rigs. anymore. So we're gonna start trading oil in other currencies. Then what's gonna happen is that people are gonna well, the demand for the dollar will decrease dramatically, and then so the value of the dollar will decrease, and they're gonna have to print more money, and so this is the path that I see for hyperinflation.
I mean, it's certainly a possibility. Who's to say what will or won't happen?
Yeah, we
I
cannot
mean,
we
it's
cannot
I
know, but
guess in theory it wouldn't be hard to settle a barrel of crude in any currency for that matter. I mean, all you have to do is price it in the currency and exchange it in that currency. There's no rule that says anything has to be settled in any one currency. For all we know, it
well,
could be settled in crypto one day.
yeah, well, there's no rule, but I forgot their name, but before like all of this, the petrodollar agreement started to weakening in the last few years.
Uh-huh.
Before that, the two people that tried to trade large amount of oil in non USD got killed. Got did you saw it?
All right.
I forgot their name, but do you know their name?
No, 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 no.
Yeah, but there were two like big general that tried to trade oil in the big amount in other currencies than the USD, and by coincidence, they got killed real quick.
I had an
So
accident.
and so it's kind of a firm agreement. Well, and it's starting to weakening, but the petrodollar agreement is kind of the core agreement that protects the U.S. Economy. Hey, there's the military, of course, and the economy is strong, but regarding the dollar, I mean, it's what keeps your demand for the dollar high, and also another factor that is a little bit more unknown is that countries with their excess of US dollar, whatever that means, they have to buy US bonds, US Treasury bonds. So that keeps the demand for your bonds high, which gets your interest rates lower. So, I mean, if all of these agreements, international agreements, start to weakening and start to fall, this is where we're going to see hyperinflation.
Perhaps, perhaps. I mean, there's a lot of countries that have very significant uh, reserves in dollars too.
Mm-hmm.
Like for example, the Asian financial crisis. Those countries didn't save in dollars, but they borrowed in dollars a lot. And when rates went up, or exchange rates went up, for example, and the dollar became more expensive to service that debt, a lot of these countries collapsed. Their financial systems collapsed. So they've learned, and they borrow, not borrow. I mean they collect and reserve lots of dollars
Mm-hmm.
for any kind of weather, if you want to call it that.
Yeah.
However, the seas, whatever tides are rolling through the seas, they do have dollars in reserves. But the mixture's probably likely to change. I think euro's the second highest. Um, but right, I mean, right now it's the dollar. There's no doubt about it.
Yeah, yeah. I think because I'm not arguing that Chinese is ready to take over the world reserve currency or world order. Uh, what I'm arguing is that they are on the path and they are on the rise. They still have a lot
Yeah,
of work to do. They still have a lot of currency to print because there's not even enough Chinese yuan to actually replace the USD. They have some money to print. They have a lot of work to do. What I'm arguing is that they are on the rise and they are on the path and they are working on it.
no doubt. I mean, that's no doubt about that.
Mm-hmm.
So hopefully, I mean, great. It'd be amazing to see both the countries working together and produce a lot of prosperity, a lot of productivity. That'd be great if that's the case.
Mm-hmm.
I'm hoping for that. I'd rather bet on that
Yeah.
because the
So
alternative is,
a co-world order.
yeah, the alternative is rough.
The alternative is rough, and that's why it's I think it's a little bit overlooked because it's not nice to imagine a world where Chinese, a dictator, uh, authoritarian government that it's basically like a dystopia. It's a dystopian alternative to the U.S. right now. So I really hope as well that it doesn't happen. But it, at least what I see is it's kind of a trend that's starting to form more seriously.
Yeah, there's a lot of good research published on it. There's no doubt about it.
Mm-hmm.
and the data is certainly trending in those directions. So it's
Yeah. So
interesting to
I
keep an eye on.
so I know you also studied Ray Dalio's work.
Mhm.
Um, and he says that there's multiple, there's like 9 variables, I think, that dictate the strengths of a government. My god, my camera is going crazy. So there's 9 variables, or 8, I forgot, that dictate the strength of empire. So, and he's arguing that some of the leading not leading indicator, but the first variables that usually begins to fall, has begun to fall in the US. I forgot which one. I think it's education. He argued that it's
Yeah,
starting to fall a little bit.
edu-
So yeah, what is your point of view on that? Do you see the US, some variables of the strength of the empire starting to fall, or do you see it still rising?
yeah. I was actually just reading this over the last couple of days and having conversations about this. Like the education system, for example. If you go to areas where there's a lot of poverty, for example, or lower income earning areas, the public school system is probably not so good.
Mm,
So that's probably fallen behind the curve quite a bit relative to other countries. Whereas our higher level institutions, like the universities, they're best in the world. So I think there's a huge, but not everybody goes to the university. So I haven't been to schools in other countries, so I can't speak to how great they are or how great they aren't. Um, but I think people know, at least in the United States, that the school system in like your lower income areas, the public school systems are probably not the best. So but on the same token, if you look at our universities, we probably have the best university system in the world.
yeah, but they're expensive.
Expensive for sure. You have to borrow to get into them unless you get assistance. So that's tough, but yeah, definitely. I mean, I've studied the material. Relative trade. Our relative trade. That's another one. That's one of the early risers and earlier. Also one of the one. It's a leading indicator. It's one
Hmm.
of the leading indicators. Trade, for example, on a relative basis, we've definitely lost ground to China and some of the other countries that have gained ground on us. So you can see that curve based on that material that we read. Um, it's absolutely. It's kind of once you read the information, you start thinking about things. It makes perfect sense.
Yeah, yeah, definitely. And one other indicator that he talks about, it's not one of the 9 indicators, I don't think so, maybe it is, but one of the things he talk about, I'm talking about Redalio right now,
Hmm?
is the world order develops new technology, but the price of labor is cheaper elsewhere, and so the other countries start using the technology created by the world order, and the labor in the foreign countries that are non-world orders is cheaper, so now they can compete with the world order. And this is one of the leading indicators of the world order starting to lose trade power. And how clearly is that, like, this is exactly the situation with the US, right?
Yeah,
And it happened with Britain, it happened with France, Spain, every world order. Like, it's a pattern that repeats itself, and it clearly, we like, nobody will argue that this isn't happening with the US.
no doubt. I mean, it's clear. It's as clear as day. There's no doubt
Yeah.
about it. You can see it. It's there. It is what it is. So
Hmm.
how do you deal with it? I mean, I guess that's the biggest question. Who
Hmm.
has the power, and how does it get dealt with?
Who has the
For
power?
example, when it came to the trade wars, when I was transacting payments for small businesses, one of the things that happened in 2017 as part of these trade wars that we've been going through, when Trump was president, he put tariffs, significant tariffs in China and Europe on certain products. And I would call these companies and have conversations with them, and it definitely hurt them.
Hmm.
There's no doubt about it. A lot of companies would have to find alternative suppliers either outside of China, so they have to leave China. They would go domestically in the U.S., or they'd leave Europe and go to Canada. And I talked to these guys all day long. That's what they were doing because they couldn't afford to pay an additional 30% on a product that maybe only had 40% margins.
Hmm.
They just couldn't afford to do it anymore. So they had to find alternative paths. So I mean, that stuff like that, you start taking business that's channeled to China, for example, because that was one of the areas that was under attack with the trade wars. And then all of a sudden, there's people that were buying things from China, and now they're buying things from Canada or domestically, for example. And in the end, ultimately, talking with these with these companies, it hurt the companies. There's no doubt about it. It hurt the companies because it's hard to shift. It's hard to shift your suppliers in short notice. And so I talked with a lot of these people, and it's, if there was ways I can help them with, offering better exchange rates, better spreads, or, hedging out some of these conversion costs, I would do that for them, or I would at least offer to do it, and they'd either take me up on it or they wouldn't. But it's kind of neat working in the global markets because you get to talk to all these people and you get to read on the sentiment as to what's happening. So the trade wars, that's part of all this that's happening with the technology and everything going on. It's all connected at the highest level of politics. But at the lowest levels,
at the highest level of politics, the real people that has power, they're the one controlling everything.
Yeah, and guys at the low levels like me, you're common worker, you're going out and working in these global markets, and I'm talking to these people that are transacting overseas, and it impacts everybody. So one decision at the top trickles down and impacts everybody. So that's why for me, that's why I like to study the highest level stuff, so we can get an idea, like, how do we navigate through this?
I mean, definitely, and I think in all areas of a scientific endeavor, I think going to the top, studying the most macro thing is always the most interesting, right? Like in economic, how boring is microeconomic, right? Like you want to study, like the most interesting thing, at least in my opinion, is like the macro of the macro of economics, like the big things that is going on in the world. And same thing for like fundamental science, right? If I were to study science, and I actually I thought about it, but if I were to become a scientist, I would want to study like the actual rules of the universe and how matter is formed and like the fundamental things. So that's always the most interesting things to look at and the most important. And you leverage your time way more when you're studying the actual, because it's all from the top. It's all of a snowball effect, right? So you want to go down to the real cause of why unemployment rate are starting to rise. Is it because of this? No, but because this is caused by something that happened earlier. So say it's always fundamental to go back to the top and to go back to the first not variables, but the first uh, situation that caused all of this.
Yeah, I got a good story for you. Speaking of like big macro stuff, so in 06 or 07, 2006, 2007, I did a study abroad program at Oxford. And it was international relations, which was really cool stuff that I love. Politics, it's chess at the highest level, more or less. And these professors that were there, they were political war advisors to Ronald Reagan, Tony Blair, Margaret Thatcher, at the highest level. And so when they would advise, decisions were made, and it impacted everybody's lives. So they told us this one story, and we covered a lot in this program. It was a winter study abroad over the winter semester. Covered a lot, but the one thing that stood out more than anything else, and I think about it often, is during in the 80s, these guys were advisors to Thatcher and Reagan, and there was a war against Russia, more or less. After W2, the other remaining superpower than the U.S. really was Russia, the USSR. And so we were in this Cold War, which was really hot in other areas because we're containment against communism was really what the war was about. But with Russia, we had all these battles. And so they sat down and they were telling us, these guys sat down as advisors to Reagan, and they thought, okay, how can we defeat our enemy? And one of the ideas that was presented, and they laid this case out to the administration, was why don't we just engage in an arms race? Because we know that Russia will spend dollar for dollar with us in really anything that we're doing. Like it started with space, and then it turned into an arms race with nukes and in the military. And they also knew, too, that capitalism and communism, when compared together, communism cannot produce at the levels that capitalism can produce. So eventually, their communist system will hit a limit. And when that limit's exceeded and we keep spending above that limit, they will collapse. And so they put this plan together and they executed it. And these gentlemen in this room operating this chessboard at the highest level were partially responsible for the collapse of the Soviet Union. And that story really stood out. I'm sitting in a room right now as a student listening to some people that have convinced the leaders to make decisions that have changed the world forever. I thought that was amazing.
That is crazy. And so the decision was to increase the spending of for the army.
Yeah, the arms war. Yeah, remember the nuclear arms? There was the
Yeah,
nuclear arms race. So they just knew that if they spent as much as they possibly could building up the nukes, Russians would do the exact same thing and match them pace for pace, dollar for dollar.
that that is crazy. That's like you said, it's a chess game and a well played chess game.
Yeah, it worked out. So
Hmm.
just at the
Well,
highest
yeah.
level. So yeah, to me that's the most interesting stuff in the world to learn about and study because
Hmm.
it impacts everything we do.
Hmm.
Um,
And I love my favorite movie is The Big Short.
oh yeah,
Um, and there's this quote that I forgot his name, but one of the main traders says it's like every time the unemployment rate goes down 1%, like 20,000 people die, something like that. And it's a crazy quote like this. I forgot the exact number, but it's in the same water. So and it's actually true, right? Like I did some research about it, like because it's a crazy quote and it's actually like a true statement. So some these decisions, they impact so much the life of regular people, but regular people don't even begin to understand, to have a little clue about them, but their
mm-mm.
life are drastically impacted by them.
But everyone feels it too. Like when I was growing up as a kid, my family, their business is in construction. So when rates are low, money's flowing and there's a lot of building that's taking place. People are getting mortgages, they're buying homes, and that's the feasting time. But when
Hmm.
rates go up and less people qualify for mortgages to buy homes, the cyclical downturns are severe. And growing up as a kid, I can never like really understood like, hey, why are these things happening in my life? No idea. I'm just a kid. I'm just going through it. And that's one of the big reasons why I love studying these things so much because growing up, I lived through so many of these cycles that I didn't have any understanding behind, but I knew they were there, and then that led to my studies in economics.
Hmm.
And so now I can see like, all right, when rates go up, less people are going to borrow money. There's going to be uh, less purchases of debt. Buying
Yeah.
things with debt, like homes, for example, and it's going to lead to a very significant slowdown
Yeah.
in certain industries. So you can start to anticipate these things, and you can get ahead of it and make decisions before it even happens.
Hmm.
I did the same thing with COVID, for example. Um, Before anybody was really talking about it in the United States, some people were, but it wasn't in the media. But you can go on like social media and you can see that there was clearly something happening in China. A lot of it was probably fake, some of it was probably real, probably the really dramatic stuff was probably not even real, but it was clear that there was something. Some people were talking about it, but it wasn't like an elevated, heightened thing like, hey, this is coming. And so, but it seemed apparent because I started looking at the flight records. There's these tracking apps, and you can look at all the different flights in the world at any point in time. And eventually, as things progressed, incoming flights from China to the U.S. were shut off. But you can look at these flight trackers, and you can see the flights are just going to other countries and they're coming right into the United States. So it's not like none of it was really prevented. There wasn't didn't really have an effect, at least in
Hmm.
my opinion. But you could look at this and be like, all right, if this is what's happening in China, this is likely to happen elsewhere in the world. So what's the economic impact of this?
Yeah.
And
But
so
it's always easy to say that in hindsight, right? Once it happened, to say, yeah,
yeah,
it was easy to predict. But
I did this. I was doing this in real time. This
did you
was real
predict
time.
the COVID?
No, 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 no,
Okay.
no, that's impossible. But
Yeah.
cause and effect, you can see. Listen, if this is the big thing in China, and you can see that people are traveling all over the world, it's likely that this will be a big thing in other places too.
Hmm. Yeah. But just paying
So
attention,
yeah,
that's
you're just paying attention,
the thing that,
right?
like, the first thing to do, but that most people just don't do, right?
Yeah,
Like you said, if you were paying attention, it was possible to predict. Like in 2008, the reason why nobody predicted it, except some people, like in The Big
people
Short,
did.
um, is because nobody was paying attention. So it's
Right.
about paying attention to the right things. Once you pay attention, then you it's not that hard, I think, in my opinion, to actually predict, but you have to pay attention to the right thing.
Yeah, it's true. And then it's like, all right, if that's a thing in China, it's hard to tell what is and isn't because everything is information
Mm-hmm.
is it is what it is over there. It's likely to be a thing in other places. So, okay, what are the economic implications of that? Well, what do we know about China? They produce a lot of the world's goods right now. It's a big part of it's kind of the central area of the global supply chain. So if China shut down, that means the global supply chain is likely to be crippled
Mm-hmm.
significantly. So then I started looking at shipping records, for example. Like, all right, well, how long does it take for a ship to leave China and enter the ports in San Francisco? And so I look at shipping records with about a 2 week lag, and I noticed that shipments had fallen off a cliff. There really wasn't any shipments. So it was confirmed at that point that things were very significant economically. Then I started reading books on pandemics, the psychiatry of pandemics, how people respond. They
So
tend
was
to.
that before the big crash in the stock market?
That's what I'm getting to. It was so a lot of these things weren't really priced in the markets, and so you start thinking about these things like, man, this could really be something. And so I called one of my buddies on the research desk that I'm still in contact with, and I started talking about some of the things that I'm seeing. Are you seeing the same things too? And he's like, yeah, I am actually. I was like, okay. I thought I was crazy, but apparently these things seem like they're likely to happen. So I started looking at like Australia, for example. Australia, their biggest customer globally is China. China buys a lot of raw materials from Australia for their steel manufacturing. They buy a ton of iron ore. So if China is not producing and distributing, then that means they're not buying products from Australia. And if they're not buying products from Australia, that will significantly hurt their GDP, their output, you know, Australian output, economic activity. In which case, the RBA, which is the Reserve Bank of Australia, it's very likely that they'll probably have to start cutting interest rates. Well, if that's the case, the Australian dollar most likely is going to fall. It's like, all right, well, this is interesting. I think we have a short on our hands with the Australian dollar. What do we pair it with? And you look at like the Japanese yen, for example. Interest rates have been at zero, literally for since the 90s. Since they had their collapse, they've had very low rates, and so a lot of people will borrow in Japanese yen because you can borrow essentially for free, and then you can reinvest it in other areas that are higher yielding, like in Australia with the Australian dollar in their currency, and you can collect the carry, the interest rate differential. But if it seems like the Australian dollar is going to fall, a lot of those carry trades will unwind very quickly. So I went short Australian dollar, Japanese yen, anticipating that this was going to happen because none of it was priced in yet. I mean, there was a little bit of a sell-off, but it wasn't really priced in. That little bit of a sell-off was kind of an indication, like, hey, this could actually be a thing, and it worked out great. It
Mm-hmm.
worked out amazing. So like just paying attention to stuff like that, the cause and effect. Um, it's kind of fun. It's a game. It's a fun game.
I mean, you nailed it. Predicting, because like I said, nobody was paying attention except a few people, and I mean, good job on that shirt. So right now, are you short the USD or are you long? Like if you were to
Uh,
take a
I
position.
got I got short euro dollar, uh, 4 weeks ago
Mm-hmm.
when it broke a significant technical low, top of a channel, consolidated for a handful of weeks, and then finally broke down. So I've been short around the 108, I think like 108.50 or 108.60, and I'm still in it, but I'll
Yeah.
probably be getting out of it. A lot of
Looking
it's
at technical as well, I guess.
mhm. Yeah, big time. Yeah, because uh, when you're looking at the markets, the fundamentals are one thing, but the price action is what you're actually trading.
Yeah.
And so the fundamentals are great, and it's a lot of times they'll shift, and they'll shift in unanticipated ways based on expectations. And so, but price action for the most, it is what it is. So, you look at the price action, look at the technicals, and if things line up, if there's fundamental support and technical timing confirmation, then
Mm. And
that
I really think like you should trade commodities because they're way easier to predict in a fundamental level. Like doing all of this work to look at the fundamental of the countries and to predict the foreign exchange market. Uh, but with commodities, I think you could leverage your expertise way more easily, right? Just with oil is pretty easy to predict, right?
That's what I did.
Demand what?
That's effectively what I did career wise. I mean, I saw what was happening to oil, and I just jumped into it.
Yeah, yeah. I
So
mean,
that was a bet. I was speculating on the industry itself accelerating in terms of price and activity and everything in the recovery, which has happened.
mhm.
Um, almost. I mean, when I got an oil uh, spot was 35 a barrel, so there's a little bit of recovery.
Yeah. Did you buy it like you took a long, or you mean like you changed
No,
the
I
trajectory?
I invested into the wells, like the
Okay.
actual the oil wells themselves.
Hmm.
But you could have gone into the futures market and bought the futures contracts for sure.
Yeah. Yeah, definitely. And yeah, I think you know predicting the not predicting, but analyzing the supply and demand of oil is way easier than the supply and demand of like the US dollar versus the euro dollar.
Hmm.
Not the euro, just the euro. But yeah, because the demand stays pretty much the same for oil, except in time of big international conflicts. But then the supply, if you can predict a big supply cut, right? Some oil rigs in the United States shutting down or whatever supply cut there is, it's so volatile, and so you can make big money with this. Like
Yep.
you remember the week where basically all there was all of this movement regarding the world reserve currency and the BRICS countries. Like there was a week where all of this happened really fast, and like everybody was kind of scared. um Saudi Arabia decided to cut oil production by like a big amount, and because of that like it was even a little bit lagging, like the reaction, but it was a big reaction. So I think it's one of the easiest fundamental to follow. Comparing, like, if you want to follow the fundamentals of stocks, it's you have to consider, are you in a bear or a bull or a bear market. So there's a lot of things to consider. But
Uh-huh.
I think like oil and gold, mostly oil, fundamentals are way easier to play and to trade, in my
Yeah.
opinion and in my experience.
Yeah. It's kind of interesting. Um, like for example, when oil prices go up, service costs in the industry tend to go up, and it becomes more expensive to drill the wells. And if it becomes too expensive to drill the wells, companies will just stop drilling. There's other things that can happen too. You have like the Inflation Reduction Act. They want to tax these big companies, these big oil producing companies, and so some of them just say, "Hey, listen, maybe it's not worth it to rapidly drill." You have politics that come into play. Because I talk to a lot of guys out in the field. Politics come into play. So if oil is under attack, for example, by an administration, investment flows into that industry will shrink, and
Mm-hmm.
so it limits production. It tends to limit production. Um, Whereas when I say production, drilling new wells. Whereas if oil prices fall, like coming out of COVID, if you can get the funding for it, you can drill wells for really cheap. And so eventually there's a lag to when oil prices fall, more drilling takes place. When more drilling takes place, production will come online, but typically oil prices tend to rebound. And then once oil prices rebound, you have the production, you can sell at wider spreads. And when oil prices get really expensive, for example, less people or less drilling activity can tend to take place, which I've noticed, which is interesting. Also, too, bigger picture, when oil prices fall, like we've recently seen, like you were just mentioning, OPEC they'll cut supply,
Yeah.
just limit production because they want to support a healthy price,
Mm-hmm.
which is really interesting. So there's a lot of variables at play for sure in oil, but you're
Yeah,
right
right now
about that.
I'm long on oil right now.
That's probably a good time to be long on oil.
Mm-hmm.
Big floor like 65, 70 in terms of technical price,
Mm-hmm. Yeah,
and
that's where I bought. Yeah.
demand for sure. Well, not for sure. I mean, it's tough to say anything's for sure. If the economy falls apart, there's may not be the demand, but at least OPEC, for example, I just did a webinar on this for some clients. Demand throughout the course of 2024, for example, it's expected to go up by about 2 million barrels per day in production,
Mm-hmm.
which is good. Whereas supply is relatively fixed. You're going to have an increase in production in North America, but a decrease in production in OPEC, a decrease in production in Russia. And so on balance, supply is probably will remain flat, maybe come down a little bit, whereas demand pick up a little bit. And
Mm-hmm.
also too, with oil prices, a lot of it's speculative too. As you know, traders can really move the market around quite a bit.
Yeah.
I mean, it
Yeah.
looks where you bought looks like a good place because there's clearly a floor there at like 65 ish.
Mm-hmm. Yeah. There's it went to that level in the Mars of the 20th of Mars, uh, and I bought, but then I did I got not even stopped out, but kind of stopped out by
Mm-hmm.
like a wick, and then it flied out really quickly, and I was so mad at myself. Like this was the prettiest long ever. But nah, it went back to the level. So I bought again, and now I didn't got stopped out. You know when you get stopped out by like a little like one pip, that's what happened.
Oh, I know.
Um,
I definitely know that. Sure.
yeah. Um, yeah, and that's why it's speculative. So it's I wouldn't ever do an investment fund based on this because it's speculation. I'm doing it. I'm doing it with my own money and with not for fun, but f- for my own money, and I'm not counting on this to pay rent.
Right. Yeah, and
Mm.
you're playing the game.
Yeah, and you know that one of the thing you mentioned about that of course trader moves the market in oil, but mostly again in the let's say the S&P 500. One of the reason that it's really hard to predict, right? And even if you follow the economy, it's hard to predict. It's because the price of the market, the S&P 500, is what the market thinks the economy is headed. So in order for you to predict the market, you have to predict what the people will think of where the economy will be. So it's kind of it's not just predicting the economy because if you're predicting the economy, then you're not predicting the stock market. You have to predict people's expectations of the economy in
Yep.
advance. So it's I don't try to predict the S&P 500. I think commodities are way easier to predict in my opinion.
Mm-hmm. Yeah, it's a fun game. It's a tough game,
Mm-hmm.
but it's a fun game. There's always those variables, those one-offs that you didn't think about. That came up like COVID, for example. That was a big one, a 100-year
Mm-hmm.
one. I don't think anybody. I mean, there's probably some disease experts that were probably like, "Hey, we're coming up at that time to where there's maybe something," but who? I mean, that's I don't know anything about that stuff. And then you have these you have these the recent the cracks in the banking system. Who knows what that could lead to?
Yeah.
That could be significant. But you saw the whole financial community, the big banks come together and say, "Hey, listen, here's First Republic, here's $30 billion. Just take it, whether you need it or not. Just take it." And we'll probably continue to see that because I mean, if the confidence gets lost in the banking sector and there's a run, uh, who
Yeah,
knows?
but I think what's most likely to happen is that little banks are gonna start to fall, and the big banks are gonna absorb them. Like we saw it with First Republic Bank, all of these banks. I think it's gonna continue. We're gonna see a few more small bank crash, um, but like U.S. Bank or like other big institution, J.P. Morgan, Morgan Stanley, they're gonna absorb. They're not gonna the bank run would have to be massive, and I don't really see a situation where there would be a so massive bank run that U.S. bank would crash.
Let's hope not.
I mean, if there is, I mean, at least I'm gonna be right in my prediction regarding the U.S. dollar.
Yeah. Well, whoever's holding Bitcoin will be very happy in that scenario.
Yeah, I don't know.
You don't
Yeah,
think so?
in the short term, yeah, but in the long term, I don't think Bitcoin will be an alternative. But yeah, I mean, we because the reason is I don't think it's aligned with the interest of the governments and the people in power. And when something is not aligned with the interest of the people in power, it most often doesn't happen. So if and we saw how easy it was for FTX to collapse. So they don't even have to go after I think like the whole cryptocurrency market. They just have to go after the big brokerage, in my opinion, at least as a short term play to weaken the demand of for crypto, right? If the Fed really wants to take down Binance, they would take down Binance, in my opinion. And one of the best example of the fact that the Fed and people that really has power always get what they want is something that Bridger's dad, John Pennington, aborted in the conference we were. You know, when inflation, and you said, you talked about it a little bit in the podcast earlier as well. When inflation was crazy and the demand for gold kept increasing because people lost the confidence in the value of the dollar, what the U.S. government did is they forbid to hold gold. So you could not hold gold. It was forbidden. You couldn't even have gold in your basement. If you did, they would seize it and take it away. And most people don't even know that happened. And this is something that makes you realize, like, man, the governments and the people in power and the feds, they can do basically what they want. They basically said it's now illegal to have gold, and big to, of course, increase the value of the dollar. But then one of the next thing that Bridges that didn't talk about, which is even crazier, is that I'm pretty sure about the dollar amount, but don't quote me on them. But when they seized the gold of everybody, it was $27 a pound, or whatever. Yeah, a pound, I think.
An ounce, yeah.
An ounce, yeah, yeah, that makes more sense. An ounce. And eventually, of course, they allocated gold to the market. But did they reallocate gold to the market at $27 an ounce? No, they did not. They did it at $35 an ounce. So just like that, just like that, by clicking the finger, they said, "All right, gold is illegal." Took all the gold. Now, right now, magic. The price of gold is has now increased by almost 30%, by a lot of percent.
Sound,
And now they just made a incredible margin on that.
sounds like
I
a
would
nice trade.
Yeah, it's not even yeah, they bought it all and then they sold it all for higher. They make the rules, and that's what people that is what people have to understand. If they want something, if they want to make crypto crash, if they want to make Binance crash, they will do it because they control the economy, they control the big factors. If they were able to seize all of the gold in America and to magically increase the price and nobody give them shit, everybody just accepted it, they can. If crypto really goes against their interest, crypto doesn't stand a chance, in my
Yeah,
opinion.
that's interesting because I mean the only way to get rid of like Bitcoin, for example, is to shut off the internet because it's a totally decentralized network,
Mm-hmm.
peer to peer. Government has no control over it. I mean, they can make it illegal, but they made booze illegal in the prohibition days, but that didn't stop people from trading booze. I'm not saying that that's what this is, but I don't. They could outlaw it, like it's outlawed in China, for example. But people are trading it. They're using it as portals to get their money out of China, for example.
Mm-hmm.
It's,
Well,
it's
I
it's
mean,
interesting technology, though. I like to transact. I do transact on DeFi platforms right now. I'm trading so non on exchange, completely decentralized. There's some really neat brokerages out there. If you want to call it a brokerage, these exchanges that are not you don't really they're not like FTX type exchanges, but I don't know how these things get regulated. I mean, I guess you could just say, hey, it's illegal, and trade at your own risk type thing. I don't know. It's interesting.
I don't think they would make it illegal. Um, I think they would go after it in a social manner, right? They would make it like, maybe they won't encourage it socially, because at the end of the day, they do control the information, especially with the internet. I also think, but that might be speculation. Uh, I think they would go after, like I said, the exchange directly. So as soon as an exchange would start to get big, they would do something to it. But I'm not saying that they will, because it's all speculation, 100%.
Yeah.
But and I'd love for crypto to get adopted as currency, and of course it won't be Bitcoin. Like, Bitcoin is it's way too volatile. It would be like a stable currency, a stable cryptocurrency, and I would love for it to be adopted because it would be decentralized. And the big alternative to crypto as a digital currency is central bank digital currencies, and
Hmm.
like, and this is something I don't want to do. I would hate that happened. um so for the people, it would be way better for crypto to be adopted, but for the government and for the people that are in charge, it like big corporation and everything, it would be way better for digital currency to be adopted, because then they control the amount of control they have just increased by an
I know.
exponential amount.
So they are like it's been in when I was in the payment space. It was like early development. I can't think of the name of it right now, but they do have their their digital, because they have to compete with these new technologies, and the Fed wire system is massively outdated. Like if you compare it to Europe and whatnot, our wire system is slow, super manual. So they're updating it, and they are incorporating. It's not blockchain technology. I can't think of it, but they're definitely upgrading their technology to keep pace with the competitors that are out there. And who's to say that it wouldn't be a CBDC, for example, central bank digital currency? I don't
And
know.
that would be a totally dystopian reality. And that goes that aligns so well with, I think, the rise of China, right? Because China is definitely the kind of country that is starting to consider it, and that will definitely consider it in the future, right? Central bank digital currencies. It goes right in hand with all of their philosophy to be an authoritarian system, and to they're basically like Big Brother right now. They have like a social credit system, so for them, a central bank digital currency would make perfect sense. And it's kind of I think it's kind of the two variables that seem uncorrelated, but that might be actually that goes hand in hand. The rise of the possibility of a central bank digital currency with the rise of China. If that happens together, I mean, that could be a big hit on personal freedom.
I agree with you. Yeah, more freedom,
Less
not
freedom.
less. Yeah.
Well, in that
Well, yeah. I
situation, it
mean,
would
for
be
us,
less freedom.
more freedom for the people.
Hopefully, yeah. But yeah. Anyway, I'm trying to keep the podcast down to 60 minutes.
Uh-huh.
That's kind of my rule of thumb. But it went by really fast. I'm not gonna lie, and it was great having you as a guest. I love talking with you about macroeconomics. We didn't even get to dive that deep into your journey, since we got to engage in a macroeconomic conversation,
Yeah,
but
well,
that's
that's all
perfect.
part of it.
Yeah. So thanks for coming in. And do you have any last word for the audience? And also, if people wanted to reach out to you to learn more about you, to contact you for whatever reason, how should they do that?
Yeah, I guess LinkedIn is probably the best. Just my name, Gary. Last name is Curtis. That's Kerdus. It's a professional network, so that's probably the best spot. Message, whatever. But yeah, that's pretty much all I got.
All right. Perfect. Sounds good. So thanks for listening, everybody, and have a great day.
Thanks, Alexis. Take care.